As you might have gathered from that brief bio, I'm not a financier, I'm a psychologist. And not only am I a psychologist, my other job is designing extremely complicated IT systems. You know, the kind of thing that the government is always setting up and then actually failing comprehensively to deliver? Well, my job is to find ways of actually succeeding in delivering those things. And I think that what we're looking at here in terms of changes to the financial industry is analogous to that. And the way that I go about it is you figure out where you want to go, but you don't try to go there. You try and find short-term ways of actually succeeding to make small steps on the way towards where you think you want to go. And what you find out on the way is that actually you don't want to go there, you want to go somewhere else. It's similar, but whatever. It's a process. Now, the thing that fascinates me as a psychologist about the financial industry is that we seem to have developed an environment in which we are spectacularly maladapted to behave correctly. If you look at the range of biases that get triggered by just normal behaviour in the financial environment, it's unbelievable. There are dozens of them. I write about them all the time. Hindsight bias, over-optimism, disposition effect. The list just goes on and on and on. Yet these are perfectly normal behaviours in what would normally be, oops, what have I done here? In our normal environment. Okay? We don't like risk, we tend to run away from it. Okay? Uncertainty scares us, we tend to run away from it. And this is a problem when it comes to finance. We behave in a way that we actually shouldn't. And this has all sorts of effects, which includes our willingness to engage in very short-term behaviours, such as earnings guidance. Now, I could talk about a whole range of different sort of triggers and biases, but I just want to focus on one simple one at the moment, which is the superpower of incentives. Okay, incentives are unbelievably powerful. If you give somebody a goal and attach a bag of gold to it, okay, their vision goes like Wile E. Coyote on Roadrunner, goes and they focus, and they will do everything in their power to deliver. And that leads to all sorts of things that we are well aware of, okay? Even on a big scale. Enron, subprime. You know, look at the sales agents right at the bottom and the way that they were incentivized to hit those commissions and the way they figured out how to game the risk models and the way that people all the way up the chain almost willfully ignored the warning signs. It's all about incentivization. But my favorite incentivization story is about something called the Ford Pinto. I don't know if anybody of you know the story of the Ford Pinto. A few of you do. All right. So the Ford Pinto was in the 1960s, it was the Ford Corporation's reaction to low-cost Japanese cars starting to flood into the American market. And they came up with a goal. The goal was to deliver a car that weighed 2,000 pounds at a cost of $2,000. Nice, focused goal. And they achieved it. They delivered the Ford Pinto. And it did everything they wanted. But it did have one slight design flaw, which was that every time it got tail-ended, it blew up, exploded. You have cars exploding all over American motorways. Now, okay, that's bad, but these kind of things happen. I mean, they happen in the kind of things that I do occasionally. Not in my systems, obviously, other people's, but nonetheless, it happens occasionally. But what happened next is really bizarre, because you've got a bunch of very intelligent people running this corporation. And they didn't do what you would expect. Instead of doing what you might expect, what they did was they did a cost-benefit analysis. And on one hand, they said, how much will it cost us to fix this problem? And on the other hand, they said, how much will it cost us to deal with the legal repercussions of not fixing it? So every time a car blows up, somebody sues us. Well, it turned out it was cheaper to actually not fix it. Now, it's odd, I think, but if you think about this in terms of short-term versus long-term, a corporation that is actually deciding that it's okay to kill its customers has probably not got a great long-term focus. But that's what the Ford Corporation decided to do. And it was all about incentives. It's superpower. So if we look at things that we can do. We have a massively complicated system, and we are driven by incentives at all levels. It's not just, shareholders, investors, it's the owners, it's the analysts, buy side, sell side, everybody's got their own incentives. The question is, what can we do to achieve the greater goal that we would like here, to break the grip of short-termism? Well, let's find short-term things that we can do. And I think this earnings guidance, this quarterly reporting, whereby you're setting up targets and goals for people to hit, which people will then hit, regardless of what that means, pushing people a little bit too hard, adjusting the accruals just a little bit so that each quarter it starts to get bigger and bigger and bigger. And actually that's okay, because last quarter it was okay, and it's only a little bit more this quarter. Okay. We are basically setting people targets, allowing targets to be set, which people are then going out of their way to achieve. And if we kind of start by breaking that particular piece of the model, we start to create an environment in which we are less likely to be induced to behave badly. Because essentially we get triggered by these things and we can't help ourselves. It's what we are. We are apes. Evolved apes who've created a system that we can't control. So I think, what we're seeing here in terms of the madness of earnings guidance is we're creating a situation where we are causing people to behave badly. And this is one area we can stop quickly, which will allow us to start on a longer term path to achieve the type of financial system that I think we would all like to see. Socially responsible use of human capital. And I could go on, but I'm conscious that I would be here for another 2 hours talking about the same thing. So I think I'll stop there.
Thanks, Tim. There is one thing I'd love to hear you elaborate a bit more. I know that you said that earnings guidance sort of rests on 4 myths, I think it was. One of them was magical thinking that had the same clout as a belief in the healing power of rabbits' feet.
Yep.
And the second one was that it was embedded in the discourse of business. The third one, if I remember, was that what we needed to do, and this may be the bit you've touched on, we needed to align the goals of management with shareholders. But that was impossible.
Sort of, yeah.
And then the last thing was that, and you were sort of implying it there, I very much like the way you wove the story of the car around that. You were implying that in some way, people who were very keen on earnings guidance could be possibly dishonest.
Yeah.
And you were quoting, was it Feng?
Yeah, it's Feng, Guy and whatever, yes, it's the paper.
Is it worthwhile saying a little bit more about that connection to Frank?
Yeah, it's an interesting one. It appears to be a causal correlation between companies that start quarterly earnings guidance and reporting and companies who are actually engaged in illegal behaviour. And the psychological theory behind it is that the more often you tell people something, the more likely they are to believe you. And this is actually true. If somebody's got something that actually they're lying about, if they actually continually repeat the lie, it becomes much more likely that they will believe you. So it does appear that effectively, when you see a company start quarterly reporting, it should be a warning flag. The other interesting thing is that it doesn't actually seem to signal anything to the market. So if this is actually true and we're talking about the illusory efficient market, it's not working. People are not picking up on the fact this signal is an indication that potentially there's something illegal going on.
And it's also interesting, isn't it? I mean, now that Unilever can manage without it, GE can manage without it, Dow Chemical, Nestle, Google, all manage without it. I mean, are they ahead of the curve or are they missing something?
I don't think they're ahead of the curve, but I don't think they're missing something either. I think, if you look at something like Unilever, I've talked to a few people here about what they're trying to do in terms of sustainability and sustainable earnings. I think what they're trying to do is to establish an environment in which the long-term goals are actually not purely the financial reporting goals we've seen in the past. Even if we're talking about human capital and the investment, it's got to be measurable, because unless you can show a measurable link between what you're doing and ultimate financial success, people will not keep on doing it. And I think what we're beginning to see is some of these corporations attempting to make that link. But it's actually a very long-term thing. It's not something that's going to be succeeded in, become successful in 6 months or a year. So you have to find those short-term wins that take you from, the drawing board, the architecture, through to sustainable, short-term, successful deliverables on the way to the greater goal.
Thanks, Tim. Thank you.